Hello and welcome to this episode of InFocus. I'm Candis Fitch, Portfolio Manager at TriCert Investment Counsel, joined today by fellow Portfolio Manager and our Chief Investment Officer, Brian Durno. Welcome back, Brian.
Thanks, Candis.
Today we are here to chat about our staples and healthcare stocks. So just to start off, can you tell us a little bit about how our core holdings have done fundamentally this quarter?
Sure. Yeah, and I think that is the right spot to start with the fundamentals rather than the stock price movements, which have been, bouncing around quite a bit this whole calendar year, actually. So if we look, most of the reporting season for earnings is pretty much done, minus one or two companies, some stragglers there. So I can give you some results for the quarter in terms of the fundamentals. The group, the consumer staples, we'll start there. Maybe the consumer staples group, from the S&P 500. So this is the whole group, not just our core picks, but the whole group, grew their revenue about 4.6% or so. So kind of sort of the GDP levels. And their earnings per share growth, though, was only 0.2. So not a lot of growth came from this category. If you drill that down and say, okay, well, what about our core picks that we use to populate portfolios? We did roughly about the same on the revenue side, but a little bit better on the earnings side with about 2.1% growth, so far in the earnings.
Okay. And can you chat with us a little bit more about those quality metrics that we hone in on when we're talking about this quality approach that we have to investing?
For sure, yeah, and the role that some of these consumer staples companies play in portfolios is generally stabilizers. So that growth rate of 2.1, you might not think it's super high, especially compared to, like, say, some of the technology companies. But really, you're buying these stocks as ballast and for resilience on the top line, and they tend not to be as volatile over long periods of time. So those quality metrics are very, very important. Actually, some of the highest quality companies come from the consumer staples segment. So if you look at our group that we use to populate portfolios on the staples side, the average ROE for a company in this space is, from our choices, are about 25%. And that compares to the S&P that's somewhere around 20-21, depending on the day. The dividend yield, that's another very important, let's say, attribute that we're very attracted to. So the dividend yield from this group is rated just a bit above 3%. So that's kind of, a great little, let's say, helper towards your performance. And that compares to the S&P 500 closer to 1.3%, so much lower yields from the S&P. The growth rates and dividends, this is another great hallmark of a company that is producing value with their choices in terms of their capital allocation. Not only can they pay a dividend, but they can grow their dividend. And so the growth rate over the last 5 years from our group is about 8.7%. So that's kind of like getting a 9% pay raise, just for sitting still. So very high quality businesses.
And I think that's a really good thing to point out is I always like to tell clients that dividends are so important to us because what's better than a company that not only has profit, but can share that profit, and growing that profit on top of that really helps with the dreaded word inflation, which I'm going to say a little bit tentatively, but inflation has been creeping back into our peripherals here. What impact does that have specifically on staples? And how does this growing dividend and even just having a better dividend in our core list of names versus the S&P, how does that help us combat inflation within the portfolio?
Yeah, there's two ways to look at that. One is the dividend growth rate. You're using, say, 8.7% from our collective. That actually means that your dividends from these companies have kept pace with inflation over the last 5 years. So without having to do anything, just by selecting good, high quality businesses that can afford to increase their dividend, you've managed to run your growth rate at 9%, which is higher than the rate of inflation each year for those 5-year periods. So you've kind of kept up by doing nothing, which is the sign of a good business. Now, when we look at the fundamentals of the actual companies under the hood, how has inflation affected those companies? And that gets a little bit more mixed and a little bit more muddied. You also have the tariff problem causing some issues on the cost structure for some of these businesses. But what you can say is that they've been very resilient. And the kinds of companies that we select for long-term buy and hold kind of philosophy that we have, generally we like when we see evidence that they can increase their price. So when the cost of their goods go up because of inflation or because of tariffs, It's great to be able to see a company be able to raise prices to consumers. It's never great on the consumer side of that equation, but it's great that the company can do that without affecting their demand too much. And that's one of those things that's been playing out for a number of years now. And it does seem like it's getting a little bit harder for companies to continue passing through price increases. So that's one of the reasons the growth rate has slowed in this sector. But when you think about a 5 or 10 or 20-year holding period for some of these great businesses, you definitely want to make sure you have companies that can increase their price so that you're able to keep up with inflation bouts.
Fantastic. Let's change gears here for a little bit and talk about healthcare. So it obviously has been in the news a lot with, government intervention. Can you chat with us a little bit about what that means to portfolios and the healthcare sector in general?
Yeah, you're quite right about the policy uncertainty. There's been a lot more, let's say, noise from the administration in the U.S., both from the Human Health Services branch and the president himself, making comments in press conferences, those kinds of things that are headlines that are affecting some of the healthcare stocks, in some cases quite materially. But it's certainly adding a little more volatility than you'd normally expect in the healthcare side. So that's something that we pay very close attention to see how much is noise and how much is signal. Yeah, so that's been tricky this year for sure.
Another tricky topic, I'll use your word there, has been AI. Now, I know we're not talking about the tech sector today, but I think it's worth noting that a lot of the companies that we purchase utilize AI in some way or benefit from it. So we don't need to actually invest in it directly to feel some of those benefits. Can you chat to us a little bit about how healthcare uses AI and how it can benefit? Because I think that's one thing that we don't necessarily see that direct link as, an everyday customer.
Yeah, for sure. Healthcare is one of those spaces that, when we look back 10 or 15 years from now, we'll see that a sector that's been able to tremendously benefit from AI. And the sector actually trades relatively cheap, so it doesn't have a lot of, let's say, high hopes for changing the whole world. But it's incremental, and some of the things that we've already seen listening through conference calls and to management teams in the large cap healthcare space, is just, there's a few items I wrote down, from a few calls, but just their ability to predict mutations in cancers rather than reacting to them. We've gotten very good at reacting to mutations. Predicting mutations is much more tricky, but AI is playing a huge role in some of the R&D efforts by these huge companies. So there's a lot of money being invested in that category. So cancer prediction should probably improve over time. Drug discovery costs, so the ability for AI to discover new compounds is really quite incredible. There's these things called dark genomes, and they help find junk DNA in your body. And just that simple fact alone can be automated by AI in ways that allow companies to find better diagnostic tools, better screening tools, and to actually increase some of the raw therapy ideas. One item I might tell you about Boston Consulting Group. This is very early days, so I don't want to get too fired up about this, but Boston Consulting Group did a study about AI drugs that were produced with the, let's say, assistance of AI. So there's not, obviously you don't hand over the keys to AI in drug discovery. But for finding compounds, this can be very successful. But AI drugs, so drugs that were, had AI helping them, were more successful in the early trials compared to drugs that did not use AI. And so that's a small anecdotal minor thing. But I think over a long period of time, we might find that drug discovery and screening, these kinds of things will improve in healthcare because of this new technology.
Wow, that's very interesting and such an exciting thing to see from the beginning, how it's going to impact our world going forward. Staying on healthcare, we talked a little bit about why staples are important. They're kind of that slow and steady stabilizer in the portfolio. What does healthcare do to our portfolios?
Yeah, healthcare actually and staples, we would both categorize both of these groups as defensive in nature because their top line, their revenue, tend to be a little more resilient and not as cyclical. They don't sort of bounce around with the economy. And now we move into healthcare specifically, and you have a lot more of a wave of demographics and a certain amount of demand that is independent of GDP growth. and consumer spending and the kinds of things that are a little bit more sensitive, like say buying a car or something like that. So you buy these stocks to basically help, let's say, defend a portfolio against some of the great uncertainties that exist out there. And every sector has their, let's say, subtle differences between what makes them move around. But we are also able to find some very high quality businesses in the healthcare sector. It's a sector that hasn't gotten a lot of attention, probably in the last couple of years, I'd say. So valuations here are not as demanding as they are in other categories. But when you look at the quality of the businesses, so if I just use our sample of companies that we use to populate portfolios here at TriCert, the average ROE of our healthcare group is 43.7%.
Wow.
So it's a pretty fertile ground to find good companies. And the dividend yield, I might just finish off a couple of stats that we'd shared in the staple side, but the dividend yield from this group is about 2.3%. And they've grown their dividends about 7.1% over the last 5 years. And that whole time they're sitting here trading around, 16 times earnings compared to say 22 times earnings for the S&P.
Wow. And I think it's important to point out too that normally when we think about those dividend, juicy dividend paying stocks, dividend growers, we don't normally point to staples and healthcare as being dividend minded. We usually think of our financials and utilities as being really those dividend players in our portfolios, but it is interesting in the way we construct portfolios, how important that dividend payout has become and how much stronger the dividends are on our core list versus the S&P. So very interesting stats there.
And you didn't have to pay an expensive price for them.
Exactly. I always think back, Brian, to something you say is, value is what you pay. What's your famous saying? Tell everybody.
Oh yeah, price is what you pay, value is what you get.
There you go.
I stole that from, I won't tell you, but there's very little creativity in my department.
But I think that's so important when we're talking about what does valuation really mean, and it really means what are we actually buying, right? And to be able to buy these companies so cheap, with good diversification to our portfolios, good dividends, growing dividends, it's all part of portfolio construction.
That's right.
Perfect. Well, thanks, Brian, for chatting with us today about staples and about healthcare. Always good to hear from you on these types of questions. As always, if anybody has any questions about today's topics, you can reach out to your TriCert Investment Counsel portfolio manager or your financial advisor at your accounting firm. Take care.